I am Allan Boomer. My firm is called Momentum Advisors, and I kind of have two hats that I wear. One is as a financial advisor. I am the chief investment officer of a firm I founded that happens to be one of the largest independent Black-owned wealth management firms in the country. So that's kind of my day job, is running this investment firm. But the reason why we're all talking today is I'm also a multi-unit, multi-concept franchisee, and the main concept that I'm in is ZIPS Dry Cleaning. I have 8 stores and a bunch of development rights to build more stores as well.
If you share how you discovered franchising, and I think we read that you were initially advising athletes with franchises. So how did that happen?
Yeah, so great question. So my day job, as I mentioned, is that I'm a financial advisor. So folks come to me and say, hey, can you help me to reach my financial goals? And when it comes to athletes, they are very different than a lot of other folks, professional athletes. What I mean by that is that their economic life is very different than the economic lives of just about everybody else. What I mean by that is, like, you could be 30 years old and be economically 70 years old because your career is pretty much over. And yes, you could have another career, but I mean, the thing you did to make all the money, it can be pretty much over in your 30s. And so because of that creates like a, sort of a unique financial need, because the first client that I ever helped to get involved in franchising, he had played in the NFL for 9 years. He went into the league at 23. And so here he is, he's 31 years old and he's a dinosaur. During that time, he made plenty of money. He was really good at saving and investing. And so he had his home paid off. He had his mom's home paid off. He had trust accounts that were funded in the names of his children or for the benefit of his children. He had a full estate plan. He really had everything that you would wish for at the end of your playing career. It's just that every day he woke up with no purpose. Like, he kind of woke up and did not have any job. He didn't have any kind of thing to put his time into. And increasingly, he wanted to get into business, and people were bringing him business ideas. And one consistent theme about those ideas is that he would put up all the money or most of the money, and he would have a really, really small equity stake and virtually no say into the operations of that business. And I'm like, this is that's a recipe for failure. Like, control is a big, important thing. And, equity, should be based on how much money you put in, not based on the fact that someone else is getting equity on your back. And so I went to this guy and I said, hey, what if we figured out a way to carve out a little bit of money? When I say a little bit, I mean a percentage of your liquid net worth. This guy had saved plenty of money. What if we carved off a small percentage, and if we can take that small percentage and turn it into a business that could give you 2 types of returns? Wouldn't that be great? And the 2 types of returns we talked about, one is a financial return, but the other is a lifestyle return. And when I say lifestyle return, it's the idea that you will have a new purpose for what your life can be about. You'll have a reason for waking up every morning. You'll have the opportunity for your kids to see you in a new light, for your children to potentially work in the business, or at least they would have a chance to aspire to be entrepreneurs. And he agreed, and that's how I got started. Like, we spent a lot of time going to franchise conferences together. We spent a lot of time going to discovery days for a range of different franchise organizations. And ultimately, we signed a multi-unit deal. And I said, I clapped my hands and said, all right, we're done. Walk off into the sunset. But here, this guy turned to me and he said, look, I don't know what to do next. You've been so helpful at getting me to this point. Can you help me run this business? Help me get it off the ground?" And I said, "Sure." Right. And I'm a financial advisor. I get paid a fee to give advice. I said, "In this case, I'll do it, but one condition. I don't want you to pay me a fee. Instead, I would like for you to give me a really small equity position in the business." And that made me his partner, not his advisor, not just his advisor. And I helped him to develop his first franchise location. And then other of our pro athletes who retired from football, from basketball, I then helped them to get involved. And in the process, I got more involved. Like I started doing my own deals and, buying my own businesses. And, it led me to what I'm doing now, which, is really me running a portfolio of franchise companies that I really control. And I have a bunch of investors behind me, but I'm not requiring my investors to get their hands dirty. My hands are plenty dirty. So that's kind of how I got into it. It's kind of a long circuitous type of path, but a great one. And one thing, just speaking to the athletes who may be watching this, athletes are like the perfect franchise candidate. Not just about having the income and the assets. It's really more so that they are coachable. They know how to follow a game plan. They know how to study the playbook and then go out and execute. Like, this is the perfect setup for someone to be a franchisee. They're disciplined, they understand hard work, and they also can take direction.
So you talked about getting your hands dirty. I was hoping you could even wind back the clock. So we know, even when you were in high school, you were selling like blow pops from your locker room. Like when you were in college, you were like making money, giving people haircuts. So can you tell us about how you were exploring entrepreneurship and ideas and what you were looking for in trying to be an entrepreneur?
Sure. I'll go backwards. I just think there's like two types of entrepreneurs, right? It's one type is the one who has the idea, right? And they go into a space that maybe other people are in, like wealth management. Like I'm not the first one to ever have a wealth management company. Or they're going into a new space that, hasn't been created yet. Like, the person is trying to invent the next Google. That's one side of entrepreneurship, is coming up with your own concept. But the other side is franchising. It's the idea of, I've got the capital, I've got the ability, I just don't have the concept and the brand and the infrastructure to go out and do it. And so I want to partner with another experienced business person where I can get some coaching, I can get a playbook, I can get some branding, right? And so that's really what franchising is about. So I've been an entrepreneur for my whole life, and I'm an entrepreneur on both sides of the coin, because I know what it is to run my own business that I started, that I created the brand, but I also know what it is like to be, on the side of being a franchisee. And I'll tell you, there's a lot of power on the side of being a franchisee. Like you see the Z on my jacket. There's a lot of other folks wearing Z's on their jackets. Like, I don't feel alone. There are a lot of Z's on the map. ZIPS has stores on the West Coast and in, the Midwest and in the South and all over, so meaning I instantly plugged myself into a national brand, and that's really, really powerful. I've never felt alone as a franchisee. There were a lot of days on my wealth management side where I certainly felt by myself.
So when your clients were or are considering where to invest, there are probably several asset classes, like maybe real estate is a big one with athletes. So kind of how do you help them compare where to put their money? And you talked a little bit about it with your athlete, but yeah, it'd be great to hear more.
Sure. So I think that there's think of a continuum of where you can put your money, right? And the big thing between this end of the continuum and that end, it's liquidity, right? Because I know on this end, I could buy a stock or a bond or a fund and I know that I'll get a return, but I could also get my money back immediately, right? And so on this end, the furthest to the left is bonds and CDs, right? Like maybe you're getting a rate of return that's 3 or 4 or maybe even 5%. I then take a step to the right. Now I'm looking at stocks. There, I'm hoping to get a return that's anywhere from 7 to maybe 12%. I then go all the way to the right. I've got businesses, right? Like over here, I know that I can hopefully make, when I'm doing a franchise deal, the minimum I want to make is 30%, because I know I could get 12 over here, right? So I want to get 30 or better, because that's going to compensate me for the risk I'm taking. Like when I go into a business, I know I can't get my money back immediately. And so I'm giving up liquidity in exchange for a return. But I also know on this far end of the spectrum, I'm dealing with an active business that requires a lot of my time and effort. And I want to be paid a premium because of that. Most franchise businesses, the biggest assets, there's a lot of financial capital that goes in, but it's the people that really determines your success or failure. And so I know that there's more work involved, but I also know that the potential for returns a lot higher. I know if I go into a franchise, I can't necessarily do that well while also, doing something else really well. Like I understand that it's going to require my time. Franchises aren't typically like it's not like something I could just buy and set it and forget it. It's not like I can truly be an absentee owner. I may be able to be like a distance owner. Like I'm an owner from a distance. Like I live in the great state of New Jersey, but my locations are in Maryland and in Indiana. And, I come to visit them maybe every 3 to 4 weeks, but I'm not there every day. I'm not, working in the register every day. And the business doesn't need me to be doing that. So that's the continuum. But in the middle there is real estate. Real estate, like if I expect to get 7 to 12 on the stock market, my hope is to get, call it 14 to maybe 20% or 14 to 16% on the real estate side. And if I'm doing that in private markets, meaning I'm buying a home or an apartment building or an office building, I'm probably having to add a lot of leverage to that, right? Because I look at what's called a cap rate in real estate is another way of looking at your rate of return. And cap rates are like 5, 6, 7%. But if I lever up, if I go out and get loans, I could double or triple that. So, real estate is a great thing for the person that wants to be passive. It's a great thing for the person that does not want the headache of dealing with 20 employees. But I also know that in real estate, yes, I'm giving up liquidity, but I'm not going to probably make 30% or 40%. So I think, it's wise to have a range of different investments. Even if you decide you want to be a franchisee, you definitely need some money on the liquid side. You need some stocks, you need some bonds. And hopefully you don't put so much money into the franchise that if it goes poorly that you're in the poorhouse. Like hopefully you can structure it where you put just enough to get into that business. And the great thing is like with franchising, like you could put up a couple of $100K and make back a couple $100K. Like you can really, because of the leverage, like the 30% number I gave, that's kind of without leverage. But if you lever that up, you could be doing way better than that. So, I think you could possibly have all of those things. You could have your stocks and bonds, which are really truly passive and liquid. You can have your real estate, which is passive but illiquid. And then you can have your franchise, which is all the way to the right, which is illiquid and active. And I think if you had a range of all of these different things with a little bit in each, I think you'll be doing great.
That was amazing. Yes.
Yes, that's a great analogy. And I think we all want to have it all, right?
Why not? I want it all. You should too.
So you mentioned that athlete you were working with, he wasn't only looking to invest his money, but also to do something with himself. So what was the franchise that you guys chose, and how did you select that specific franchise?
Yeah, I won't go into a lot of specifics there, but I'll say it was in the fitness industry. And it it was fitness because I went to the guy and I'm like, what is the thing that you are the most passionate about? And it happened to have been fitness. And I then looked and said, oh, you could actually make some decent coin in fitness. And I said that from looking at all of the different, the FDDs from all the major fitness competitors. But then what I found in practice is like fitness, like I don't want to, talk bad about an industry, but in that time period, the competitors, the competition quadrupled. Like fitness became really, really oversaturated. And it made me realize that you can't just look at something you're passionate about. You've also got to look at the whole business the whole kind of macro or high level view of that industry. Like passion is good, but I think passion can like be translatable. What I mean by that is like, the guy was also passionate about leadership. He was also passionate about inspiring people to work hard and to achieve things. And like, yes, there was a passion for fitness, but I think if I could do it again, I would have said, let's expand the field of what that passion can entail. Because we got into fitness and it turned out to be a really competitive space where we did not make the money that we expected to make. But the one benefit of that fitness franchise is that in the same exact parking lot, when we were looking to build our first unit, we didn't completely know which locations would work out well. So we used our eyes. Like we sat in the parking lot at this particular shopping center. And we said, we just want to see if this is a good location for our fitness business. So we're just going to watch the traffic that flows in and out of this plaza. And as we sat there, we concluded that this must be a great plaza, the first plaza that we decided to put our gym in. And we decided that because, hey, we've never seen a dry cleaner with a line out the door all day. We said to ourselves, this must be a good shopping center because we've never seen a dry cleaner with the line out the door. So we put our gym there, and the gym did okay, but never did great. And that dry cleaner still has a line out the door. And guess which dry cleaner it was? It was ZIPS Dry Cleaning. And so that was my entree into dry cleaning. It was completely by accident. I knew about ZIPS, but I did not know how good the economic model was. But that line out the door is what got my attention.
I guess I'll add one thing there, at least for me. So sometimes people ask us, like business owners will ask us, when are we ready to franchise? And a lot of times the common knowledge will be, when you have operations and it's repeatable. But quite frankly, for me, I think it's the line out the door. So when you're able to craft something special, you're able to like outplay the competition, and there's a line out the door, then you can now transfer some of that special sauce, that magic, to someone else. Anyway,
yes.
I just think it's such a beautiful visual thing. If you see a line out the door for a business, that business is probably ready to scale, franchise, raise money, do anything they want to do.
Oh, bottom line, yeah, like any business, man, like a business exists to earn revenue, which you hope to convert to profit. And that's what I'd be looking at. Like if I were looking at a franchise, I'd want to go to the one with the line out the door. I'd want to go with the ones where it's very clear what the value proposition is to the end customer. And it's not it's not like a guess, like it's kind of been proven before.
How do you work with the franchisor with ZIPS Cleaners?
Sure. So I look at ZIPS as my friend, but also I won't say my enemy. I call any franchisor a frenemy. And it's nothing against ZIPS. This is like what you've got to do. Like it's your butt that's on the line when you are a franchisee. You're the one that wrote the check. You're the one that's on the personal guarantee, on the lease. You're the one that takes out the bank loan, right? And so they're not on any of those risks, right? Like they're not, no franchisor is signing up for that. So I'm just saying that you always have to keep an arm's length relationship with your franchisor, because you can't let them get you into a situation that's bad for you. And sometimes you got to recognize that while many of your goals are aligned with the franchisor, there's also some disalignment. There's some times when you're in conflict. You know, for example, a franchisor gets paid off of sales, right? You pay a royalty that's based on the number of sales you bring in. You as the franchisee, you get paid off of profit. Revenue, profit, these things sound like the same exact thing, except they're different, right? And so what I mean by that is, like, for example, if I were any franchisor, like I'd love to have a location in the middle of Times Square in Manhattan, right? I'm sure my sales would be through the roof if I had a location there. But as the franchisee, I got to be thinking, well, wait a minute, how much is the rent in Times Square? How much is minimum wage in Times Square, right? And so what I'm getting at is, like, I think ZIPS is great. I think that they've given me the support I need. I literally got a call today, and they're introducing me to a major corporate account for my dry cleaning services for a location in my market. Like, that's like amazing. Like my franchisor is partnering with me to help me bring more bodies in the door, more revenue and more profit for all of us, right? So they've been great. But I told that story about McDonald's in Times Square, about, you know, having a franchise in the middle of Times Square. You just always have to know that you gotta, you know, have your own judgment. You gotta have your own discretion. There have not been too many times when I've been at odds with ZIPS. It's mostly been a positive relationship where they're looking out for my best interest, and I appreciate that. And there are some franchises, though, I'll tell you, like, they are looking at their franchisees as kind of like a captive audience to charge fees to earn profits from. And, like, if you looked at the FDD, there's a section where they're giving you financial like targets for what you can expect to make, or financial costs. But there's also a section where you can see that franchisors, their profit and loss statement. And if you see in their profit and loss statement, if you really look into it, there's a section for something called rebates, right? A rebate is the franchisor. Imagine, I'll use the example of, let's say I had a French fry franchise, right? And imagine I'm the franchisor, and I'm making you buy my potatoes, and I'm marking those potatoes up, and I'm making a profit from that. That's going to show up on my profit and loss statement as a rebate. So I personally like franchises that don't have a lot of rebate income. ZIPS has zero or close to zero, right? And so that speaks to the type of relationship that we have. Their goal is to make their profit from the royalties they charge me as a franchisee, which means really our interests are very aligned. In the fitness industry, often the people selling you the gym equipment, the franchisor is marking it up. And I hate to, you know, I'm not out here snitching. I'm just telling like it is, man. And ZIPS doesn't do that. And I suspect there's a range of other franchisors who also have that sort of transparent relationship with their franchisees.
So you said you're kind of a distanced operator, like you're still involved, but not every day. So what is the capacity to which you're involved, and kind of like how does it work? Who is there day to day, like managing the business? Yeah.
ZIPS is a really it's labor intensive. Yeah, it's kind of capital intensive, but it's really labor intensive. We have 8 locations in 2 different states, and Maryland and Indiana are not close to each other. My biggest store probably has like 25 or 30 employees. My smallest store probably has 10 employees. And so if you add it all up, I probably have 100 or so employees. And it's hard to keep an eye on 100 people unless you've got a really, really strong management team. So I have a manager who's been with me from back when I was doing fitness businesses. And she is kind of like my right hand. She's so good and she's so important to my operations. I actually gave her the opportunity to be an equity partner in our cleaners. And we're going to be expanding that pool to have more of our managers join us as equity partners as well, because it really lines up our interests. Like, she now knows, or she's always been the type who'd run through a brick wall for me. But now she also knows that in running through that brick wall, she also stands to gain as the business gains in profitability. So I have really, really strong managers. I have really, really strong, a really strong district manager who kind of oversees everything. So for me, you asked, what do I do, right? So I'm involved with finding new locations, figuring out where to find the money to do everything we need to do. I'm involved in, let's say we need to expand a location or shrink a location, or we need to do a big capital project, like let's put some new equipment. I'm the one that's helping to make that sort of decision. I do visit the stores at least once a month. And when I visit the stores, I'm really just looking for what's wrong, to be frank. Like, I'm looking at garments that got ruined. I'm looking at how we're dealing with those garments. I'm working the register and I'm asking questions like, hey, what's your experience been like here? I'm one of the owners, you know. I'm working next to my staff to see if they're making mistakes. I'm looking for chances to sort of retrain them. I'm testing out all my computer terminals to make sure everything works. You know, kind of like secret shopping the place while I'm working there. But my day-to-day thing, I look at my reports. Like, I'm looking at sales reports. I'm looking at, we have our own, what I call like an management information system, where the managers give us, you know, customer counts and new customer counts and how many people came in from the promotion, the discount promotion we ran. So I'm looking at a lot of that data. I'm also looking at our profit and loss statement. And the franchisors really helped us to understand how to get to the profitability we're shooting for by managing to each line item in that profit and loss statement. So like I can look at a profit and loss statement for a dry cleaner, and I can tell you, just based on a couple of lines, if you're making the type of profit that you're hoping to make. And so our biggest one is labor. Our second biggest one is cost of goods sold. Like, those are two variables that if we can manage those well, we can make money. And those two alone can account for 50% of our cost of business.
So you touched upon something that we get asked about all the time, basically like, you know, funding and getting financing or investors for your franchise. So obviously you're like extremely experienced just working with your clients, but also doing it yourself. So we have like a series of questions. I guess the first one
Sure.
is, how did you like find the investors that you went with?
Well, it would help if you run a large wealth management firm and you're managing $400 million for 300 families.
Cool.
Like, that's yeah, but like, even with that, my first investors were really my clients who were also like friends and family. Really early on, I got my dad involved. My dad is my partner. I've made my kids partners in the businesses, using money that's mine, but I put it in their name so they could join in with me. But really, I think any endeavor like this is going to start with the folks who you know. I've never put up a billboard or, you know, an ad in the newspaper. I kind of started with folks who I know. But then, so that's for your equity capital. For the debt or loan capital, I mean, there you're talking to banks. SBA is the Small Business Administration. It is a kind of like a program by the government where banks have the opportunity to make loans that fit a certain criteria And the government says, look, I'll be the guarantor. The government says that the government will guarantee the majority of that capital, which means the risk that the bank is taking with its own capital is really mitigated. It's really small. And so SBA loans are really a great tool for franchisees. The SBA maintains a list of like a naughty list and a nice list for franchisees. And so they can tell you in 5 minutes if this is a project that they might get behind. You may talk to the banks in advance of signing your franchise agreement, because you'd hate to sign an agreement and then find out that no one wants to write a loan for that business.
And then what's a good ratio of like debt to equity?
That's an excellent question. So here's how I run my numbers. Like, for one, I always run my numbers unlevered, meaning like, what's the cost of starting the business and what is the EBITDA? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. I want to know, will I make my 30% or not, just off the EBITDA versus the cash, the full cash that has to be put in, debt and equity, right? I then say, okay, well, if I can make my 30% that way, now let me figure out what's a responsible amount of leverage that I could add to still be able to, make a really good return, but not over lever. Because the challenge, this is now a judgment call, and this is where you might work with someone who's like got a financial mind to help you to like stress test it, because looking at it unlevered means like I need to see what is my need for working capital, like how many months can I go without making a profit before I run out of cash. Now, if I add in a bank loan, I mean, that's great, because now, hey, I got some free money. I'll put up air quotes. I get some capital that didn't come from my own bank account. But what does it do? It adds to my expenses every month, right? And so it might double the loss that you're making in those first couple of months. It might increase your need for working capital in the bank. So you kind of have to stress test it, and kind of work back and forth, because the banks will often let you lever up more than you should, frankly, because the banks will lend to you based off of a pro forma, and a pro forma, that's from a Latin word that really means to project, like it's a guess. And if your guess looks really good, then the bank's like, hey, where do I wire the money? Right? And you may have been too rosy, especially, I mean, I hate to say, if you're relying on what your franchisor says you can do, right? Like they may have been overly optimistic, and now you've levered up, for every dollar of capital, maybe you've taken on 80 cents of debt, and now you're short. Because I'll tell you, like, you can't go back to the well and ask for more loan money. Like, you really got to get that right. So for me, I used to think like leverage as much as you possibly can. Like, I didn't come from a wealthy background when I got into franchising. I'm using my own capital, and I didn't have a lot. So like I used to be very inclined to lever up. Then this thing called COVID happened, right? And like when COVID happened, I realized that leverage is one of those things that can cut both ways. Like, leverage can certainly enhance your returns, but leverage can enhance your losses too. And you don't want to be in a situation where you run out of cash. And so I actually delevered my businesses during COVID. When I say delevered, meaning I took in some fresh equity capital to pay off the debt. Because the thing about equity is, like, there's not a requirement that it gives a return, every single month. Like, you can have a little bit more patience to your capital with equity, right? So for me, I would just be careful, and I'd make sure I ran a really good stress test, and then I'd stress it even more, and I'd be trying to figure out what's the optimal mix for me that maximizes my return, but also kind of mitigates the amount of risk of running out of capital. So the answer is a long explanation, but it kind of depends. I would be leery at going 80% debt. Like I'd be, even though the bank might let you do that, I'd be leery unless I had a bunch of extra cash laying around that I could use to pump into the business if things got tough.
No, I know. I get financial advice. I guess you mentioned one thing before I hand it back to Miriam that really struck a chord with me. So how you have your kids, be your partners, even if you're funding it, and how you had your dad be a partner. And earlier on, you were talking of like the athlete that retired that you started working with, and how, when he gets, he retired at 31, but his kids will see him in a different light when they see him working. So at least, one thing we talk about at WeFranch is building generational wealth.
Mm-hmm.
I think part of that is making money, but also part of that is, in my experience, I grew from a poor family and I went to, anyway, so I didn't really have this exposure, but my friends did. And I found it makes a big difference when, as a kid or when you're young, you're just around successful business people, especially
Mm-hmm.
businesses that you can understand, kind of like franchise businesses. So how exposed are your kids to your business and your decisions and the things you have to do, even if they don't fully understand? Do you talk to them about it? Is this a shared experience or not?
Oh, absolutely. I think it's a great question. Like, I want my kids' world to be bigger by seeing that entrepreneurship is on the table. While everyone else is looking for a job, I want my kids to know that they could be looking for a business to start. I want them to know that they could come and work for the family business. So yeah, my kids have been exposed. I could show you photos of my kids, 3 and 4 years old, running around the gym. One of my sons actually got his Elmo stuck in our stair climber at one point. So I think it's important for them to see, like, we are in this place, and you see everybody that swiped that key tag to walk in, like that put money in your pocket. Or you see all those people with all those bags of dirty clothes, like, they're gonna give money to you because you set this whole thing up. So yeah, my kids have always been very exposed, and while none of my children is interested in following my exact footsteps, I hope, like, my oldest wants to be a filmmaker, and I hope that what I've shown him is that there's a lot of different ways to be successful, and you can go out and create a lane that maybe I didn't know existed. Like, I didn't know you could go to college to be a filmmaker, but he's now doing that, right? So that's the hope, and that's wealth, right? Like, if your kids have more options than what you had, that's wealth. If your kids aren't just looking for a job, that's wealth, right? So I think that it can be a big part of creating a legacy in a family, is to get them exposed to entrepreneurship.
So you mentioned item 19, and that's obviously like, what everyone looks at first. But when like prospective franchisees are building these like financial models, kind of like, what other resources, materials, like, can you use to build this projection? Like, whether you're applying for a loan or whether you're just trying to make...
Sure. Yeah, I mean, I think the biggest thing is, like, you got to figure out what's not in the item 19, right? Like, for example, a lot of times the item 19, it doesn't disclose royalties in there. Like, they'll show you revenue, they'll show you some subset of your cost, but they might not have royalties baked in. So you just use that, your model is off. A lot of times, an item 19 gives you averages. Like, here's the thing about averages. Like, listen to me. Let's say Greg is a billionaire. That means on average, all of us are billionaires, right? Or we're all worth $100 million on average. But in reality, it's only Greg that's got the money. So when they're showing you an average, I'd be looking at that kind of sideways. Like, maybe you go back to the franchisor and say, well, show me the person in the bottom 20% or the bottom 10%, and maybe run a set of projections using those types of numbers. And ask yourself, okay, what happens if this is my reality? Some franchisors will give you their top 80% or their top 20%. and they're advertising that. And so I'd be looking at what's not in the item 19, and I'd really be reading the heck out of those footnotes. Like, what are the different ways that they are trying to market this thing that could be putting lipstick on the thing, right? Like, so I'd be really careful with looking at those things. So that's the first thing. The second thing I'd say, I'd use my eyes, man. Like, if you can go to one of those locations, that's one of the like the beautiful thing about the FDD, it's giving you all the information you need. It's just a question of how you use it. They're giving you a list of every franchise owner in their system. Call them. Hey, this is my expectation in year one. Is that crazy? Was that your experience? Could you share with me what your profit and loss statement look like? Like, that sounds like a ridiculously aggressive ask, but like, if I'm opening my location in, Philadelphia, and I'm asking the guy in Seattle, Washington, like, there's a good chance he might be willing to share that information because you're not competing with him. In fact, like, you're helping him because he or she wants other really good franchise owners in the system. So I'd be asking questions of other franchise owners. I'd be using my eyes as well. What I mean by using my eyes, when I was looking at ZIPS, I stood out in the parking lot and I watched people walking in the store. I looked at what were they carrying, how many different things did they have, and you can make up a financial projection based off that. Okay, I know your garments are, $3.49 per. On average, I see people walking in with, 4 or 5 garments. That means each check is probably like $15 to $20. I saw, 10 people walk in. That's 20 times 10. That's $200 an hour. I mean, like, you could really go backwards by just using your eyes. And you could even take it a step further and then say, okay, I saw how many people walked in at this location. Now let me analyze the demographics. Let me look at their traffic count. How many cars are driving past? How many people live in 1 square mile? Like, I know I'm kind of like getting real deep, but like, that's the type of input that needs to go into your projection. It's what's in the FDD, what's not in the FDD, what did I get from other franchise owners, and what did I observe myself? What kind of assumptions can I make based on that?
So what are your thoughts on like acquiring a business, specifically a franchise, and kind of like how did that play into your strategy?
Sure. So out of our 8 stores, we bought most of them. We built only 3 out of 8, and we bought 5. And there's a good and bad thing to like both, right? Building or buying. Like, if I build it, I've got hope, right? Like, I hope that this turns out to be a killer location. And in fact, our 2 locations that we built, killer locations. We did a lot of homework. I'm incredibly proud. There's a chance that you put the location in the exact spot and you do really, really well. But it's really, there's hope involved when I build. When I buy, it's like I kind of know what I'm getting. And what that means is that I can look at the profits of the past, the revenue of the past, and I could presume, as long as I don't, screw anything up, I can probably make that amount of money. But there's not a lot of hope involved in buying, because if the business is doing $1 million, the odds of it doing 2 million are kind of slim, unless you've got a really good game plan as to how you get to the 2. But like, typically, if it did 1 million for the other folks, assume it's going to do 1 million for you. And so there's not a lot of hope involved. And so what I mean by that is, like, you might buy a business and be like, man, it would be great if I was on this part of town instead of this part of town. Well, guess what? You can't go to that part of town because the business you bought is on this part of town. But if I'm building, I can say, it'd be great to put it on that part of town, and you put it on that part of town, right? So the challenge to buying is, like, you're kind of stuck in your location. You do have the flexibility of turning over your people, like you could bring in new people, But like, that's got its own risks, right? So what I love about buying is like I'm much more comfortable taking on leverage if I'm buying, because now I know with pretty good certainty how much revenue is going to be coming in, and I can plan accordingly. And a lot of banks would much rather loan to an existing business than a startup business. But you're stuck with whatever location you got. And whatever price that business owner is willing to pay, to charge, that becomes your cost of capital, your cost of getting in. And maybe they want a bigger number than what it's worth, right? So, there's pros and cons to both. We've done a little bit of both.
Kind of like, what's next for you? So you mentioned the development rights for more ZIPS cleaners. Like, what do you want to do going forward?
Yeah, great question. I'm all in on dirty clothes, man. So like I'm doing more locations. Like my stores, I thank God, like my stores are doing really, really well. And I'm just constantly looking at what I should be doing next. And what I mean by that is like ZIPS is rolling out a range of different sort of options for franchisees. ZIPS opened up a fully automated store that's 24/7 recently, where you can drop off your dirty clothes or pick up your dirty clothes at 3 o'clock in the morning if you wanted to, right? So now I'm like, I went there yesterday and I sat and I watched and I'm like, I would not have guessed that people would gravitate to this, but the folks that are in there, they're all smiling. So like, that's an idea. ZIPS just for folks that don't know ZIPS is known for being the low cost, one cost dry cleaner. So every garment, whether it's a wedding dress or a pair of suit pants, is $3.49. And and any garment you drop off by 9 a.m., you can pick up by 5 p.m. So ZIPS is really competing on speed and on price. But ZIPS decided to do like a high-low strategy. So ZIPS went out and acquired another brand called Mulberries. And Mulberries isn't $3.49. Mulberries is probably $34.99. And your garments are not ready the same day. They might be ready in 3 or 4 days. Using the similar cleaning processes, but different finishing processes. And with this high-low strategy, it's a way of kind of bifurcating the market. Like you might have someone that would never drop off their clothes at ZIPS, but they'd be very comfortable at Mulberries. So I'm thinking about, should I be bringing Mulberries into my mix? And finally, should I add, like ZIPS has historically done full plant locations. Maybe I should look at like a hub and spoke, like a location that's just pick up, drop off, but the clothes are not being cleaned there. Maybe I should look at a 24/7 location. So that's what I'm kind of thinking about, is like, where's the market headed? How should I continue to expand? And, how can I get deeper into these dirty clothes? There's definitely a lot of clean money in dirty clothes.
Like, what advice will you give to yourself? Like, what advice will you give to aspiring franchisees?
Sure.
How to navigate it?
Yeah, the first thing I'd say is like, be open to the idea that franchising is a great business model, that you can do well in it. Often, like we interact with franchises all the time, 7-Eleven, Dunkin' Donuts, McDonald's. But I don't know that we always think that we could be the owners of those businesses. And when I say we, I'm speaking to folks that maybe come from ethnic backgrounds like mine or yours that don't see themselves in those business owners. So number one, know that it's a possibility for you. Number two, be careful. Like, yes, it's a chance to make money, but you also got to keep your eyes open to know the ways that you could lose, and make sure you're not risking so much that would make you have to file bankruptcy or something like that, or lose your house. So be careful. Number three, understand that every franchise is different. They all have different pros and cons, but I'd want you to really have a very firm understanding of the pros and cons. Like, if you only know the pros, you haven't done your research well enough. Like, you really got to know the pros and cons. Like, what are the bad things? Like, it's very easy to only find the good things when you're looking to, like a lot of times when we're doing our research, we are simply looking for the information that'll validate the decision that we've already made. Like that's a horrible way to pick an investment. Like you really got to be eyes open for the bad stuff. Like what are the customers that hate this brand? What are they saying? What are the different things that could go wrong? Like what I always ask, like I was up at my kids, my daughter's looking at colleges, and this guy from the college came to our table and he's like, and I'm like, hey, give us a sales pitch for this school. And he gave the great sales pitch. Now I'm like, all right, now tell me the opposite. What are the reasons why I should not go to this school? What are the biggest things that are wrong with this place? And like, there's something wrong with every place. Like, every business has its problems. Every business has its downsides. And you got to make sure you're open-minded enough to find out those things and ask yourself, are they deal breakers or not? But never expect that you're going to hear nothing but sunshine and rainbows. I think we're on Twitter at Momentum Advice. We're on Instagram at Momentum Advisors. But if you just Google Momentum Advisors, you'll be able to find me. And if there's anything I could ever do to help anyone, I'd love to.
Absolutely. So we'll send an
also, sorry.
Yes.
There's also a podcast. We have a podcast called The Momentum Advisors. I forgot to mention that, but our Momentum Advisors podcast is really designed to talk about entrepreneurship and wealth building. And we talk about franchising every now and then as well.